Hey everyone, welcome back to the channel. If you've been watching silver prices today, you've probably seen some absolutely wild price action that's got a lot of people talking. And I want to break down exactly what happened, why it happened, and what it means for where we're headed next. So here's the situation. Earlier today, silver experienced what looked like a pretty sharp drop. We're talking about hitting lows around $30.29. Now, some people saw that and immediately started panicking. The comment sections across social media were filling up with doom and gloom. My notifications have been going absolutely crazy. People are messaging, commenting, asking if this is the end of the silver rally, wondering if they should be concerned about their positions. But here's what's fascinating and what I want you to really understand. By the time most people even finished reading those panic posts, the price had already recovered a significant portion of those losses. We're talking about a recovery that happened within an hour. That tells you something extremely important about the underlying strength of this market. What we witnessed today wasn't some fundamental breakdown in the silver market. This wasn't a sign that the bull market is over. This wasn't an indication that silver is about to collapse back to $20 or anything like that. This was a classic headline-driven move, and understanding the difference between noise and actual structural problems is absolutely critical if you want to navigate these markets successfully. So let's dive deep into what actually triggered this, what the technical charts are telling us right now, what's happening in the physical market, and whether this changes anything about the bigger picture for precious metals going forward. If you're getting value from this breakdown, go ahead and hit that like button right now, drop your thoughts in the comments below, and make sure you're subscribed because we cover the precious metals markets every single day with detailed analysis like this. Let me show you exactly what happened on the charts because the visual representation really tells the story here. I'm looking at a 4-hour time frame and you can see this candle where we dropped to that $30.29 level. This occurred roughly an hour before I started recording. We're at about 3:40 p.m. right now as I'm putting this together for you. Switch this to the 1-hour chart and you can see the move even more clearly. It was sharp, it was fast, it definitely would have made your heart skip a beat if you were watching it in real time. But look at what's happening right after. We're seeing buyers step in aggressively. The recovery is almost as dramatic as the drop itself. This isn't the behavior of a market that's broken. This is the behavior of a market that has substantial support underneath it. Now, let me be very clear about something right from the start. I don't see any reason for serious concern with what happened today. However, I also don't want to just dismiss it without proper analysis. Context matters enormously in markets, so we need to understand exactly what drove this price action, what factors are influencing the market right now, and what we should be watching for in the coming days and weeks. We also need to look at the technical setup in detail because there are some really important patterns developing that could give us clues about what comes next. And beyond just the paper price on the charts, I want to talk about what's happening in the physical market because that's often where you see the real story being told. The physical market is showing some interesting dynamics that deserve attention. If you look at dealers right now, constitutional 90% silver, what people call junk silver, is starting to show premiums where it wasn't before. Some dealers are completely out of stock. Others have raised their premiums above spot price. Just days ago, you could find this stuff at spot price, like dealers were trying to move it as quickly as possible. That dynamic is shifting pretty dramatically, which tells you something about underlying demand. When dealers can't keep junk silver in stock and when premiums start rising, that's usually an indication that physical demand is strong, regardless of what's happening with the paper price in the short term. So keep that in mind as we go through this analysis. The physical market often leads the paper market. So what actually caused this sell-off? What was the catalyst that triggered this price action? The The answer lies in a speech that President Trump gave at the World Economic Forum in Davos, Switzerland. You know, that annual gathering where global elites, politicians, CEOs, and policymakers meet to discuss economic issues and global policy directions. The president delivered a fairly lengthy address covering various topics: economic policy, energy independence, manufacturing, trade relationships, the usual talking points that you'd expect from a speech at this kind of forum. There were comments about the strength of the American economy, observations about energy policy, including critiques of wind power, various statements about America's position in the global economy. But buried in that speech was something specific that moved markets in a significant way. Trump announced that he had held a meeting with NATO Secretary General Mark Rutte at the forum, and they had formed a framework of a future deal with respect to Greenland and, in fact, the entire Arctic region. This was the setup for what came next. Then came the critical part that actually moved markets. He stated that based on this understanding and this framework they had developed, he would not be imposing the tariffs that were scheduled to go into effect on February 1st. These were tariffs that had been threatened against European nations, and markets had been pricing in the risk of an escalating trade war. Now, you can interpret this various ways. Some people are calling this strategic negotiation, the idea that Trump threatened tariffs to bring people to the negotiating table and got what he wanted without actually implementing them. Others might view it as backing down from a threat. Regardless of how you interpret the politics of it, the market reaction was immediate and significant. Concerns about an escalating trade war had been building in markets. Investors were worried about the potential economic consequences of tariffs between the United States and Europe. The uncertainty around trade policy was creating risk premium in various assets. When this announcement essentially removed that near-term catalyst, markets that had been pricing in tariff risk suddenly had to reprice. The interesting thing is how both gold and silver reacted to this news, and the reactions were somewhat different, which tells us something about market psychology. Silver had this sharp correction we're discussing. That dropped down to $30.29, but gold also dipped briefly, though its reaction was more muted. However, and this is important to understand, gold is still up 1% on the day even after giving back some of its gains. It didn't go negative. It maintained its upward trajectory for the session. Earlier today, gold actually touched $2,888 per ounce. We came very close to $2,900, which would have been a psychologically significant level. Make sure to smash that like button if you're finding this analysis helpful. Comment below with your take on today's price action and subscribe so you never miss a market update. There's still a chance we could finish the day near that $2,900 level for gold. The recovery in both metals has been pretty strong, which again indicates underlying strength rather than weakness. Silver had rallied as high as $35 recently, which put us just around $4 away from that psychologically significant $100 level. That's an important context to keep in mind. We were getting very close to triple-digit silver pricing. Some of that momentum may have been connected to safe haven flows related to tariff concerns and geopolitical tensions. When you have uncertainty about trade policy, when there are concerns about economic consequences of trade wars, investors often move into hard assets like precious metals. So it's possible that some of the buying pressure that pushed silver up toward that $100 level was related to these concerns. When those concerns eased, at least temporarily with this announcement, we saw some profit taking. But here's what you need to understand about the bigger picture, and this is absolutely critical. Nothing fundamental has changed. We're still dealing with the same underlying issues that have been driving precious metals higher for months now. The structural problems haven't gone away. The fiscal challenges haven't disappeared. The monetary policy environment hasn't shifted. Let me show you what I mean by going through the actual data and what's happening in various markets beyond just the precious metals space. Look at global bond markets because this is where you can see stress in the financial system. The United States 10-year Treasury yield, the 30-year Treasury yield, Japanese government bonds. Zodin Fabri Otsi Obin des sold or Mate Kambom. Obi after the announcement, but yet they're not returning to previous levels. They're still elevated compared to where they were just a couple of weeks ago. The Japanese 30-year bond is down about 5.57% today, which sounds like a big move. But here's the context. Yesterday, it rallied almost 9%. We're seeing massive volatility in sovereign debt markets. That kind of volatility doesn't just disappear because of one policy speech. That kind of movement indicates underlying stress in the global financial system. Japanese government bonds are particularly important to watch because Japan is the largest foreign holder of United States Treasury securities. When you see volatility in Japanese bond markets, that can have ripple effects throughout global financial markets. There was actually a really telling headline from CNBC yesterday that I think illustrates what's really going on beneath the surface. Danish pension fund to sell $100 million in treasuries, citing poor United States government finances. Think about that for a moment. A major institutional investor is divesting from US government debt because they're concerned about fiscal sustainability. This isn't some random retail investor making an emotional decision. This is a pension fund, an institution that manages money for retirees, that has fiduciary responsibilities, that typically moves slowly and conservatively. And they're publicly stating that they're selling US treasuries because they're concerned about the fiscal position of the United States government. Now, Denmark, of course, is the country that currently administers Greenland, so the timing of this announcement is notable. There might be some political motivation there, but the underlying concern about US fiscal policy is shared by many institutional investors, even if they're not making public announcements about it. European entities collectively hold approximately $8 trillion in United States treasuries and equities. That's an enormous amount of exposure. That represents enormous leverage in any trade negotiation. The potential economic consequences of a trade war with Europe would be significant, which might explain why we saw this policy adjustment from President Trump. If European investors started selling their treasury holdings in significant size, that would push yields higher, which would increase the cost of borrowing for the US government. It could potentially create instability in financial markets. So there are very real economic reasons to avoid escalating trade tensions, regardless of the political considerations. But here's the critical point that I want to emphasize. The United States national debt is still sitting at $36.6 trillion. That number isn't going down. That number continues to climb. The fact that we're not implementing tariffs on Europe starting February 1st doesn't change the trajectory of government debt accumulation. It doesn't change the fundamental fiscal picture at all. Every month, the Treasury issues more debt. Every month, that $36.6 trillion number gets bigger. And as that debt grows, the cost to service that debt grows as well, especially in an environment where interest rates are elevated compared to the ultra-low rates we saw during the COVID period. This is why these headline-driven moves can actually represent opportunities rather than threats if you understand what's really happening. The long-term thesis hasn't changed. We're still on track for higher precious metals prices based on the underlying fundamentals. Short-term volatility driven by policy announcements is just noise in the context of that longer-term trend. Let me show you another data point that really illustrates the structural problem we're dealing with. United States government interest payments hit a record $1.47 trillion in Q3 of 2025. Let me repeat that because it's such a staggering number. $1.47 trillion just in interest payments in a single quarter. Think about that for a moment. We're not talking about paying down the principal on the debt. We're not talking about funding actual government programs. We're talking about $1.47 trillion just to service the interest on existing debt. That's approaching $2 trillion annually just in interest payments. This is becoming an increasingly large portion of the federal budget. As this number grows, it crowds out spending on other priorities. It constrains fiscal flexibility. And it creates a situation where the government becomes increasingly dependent on being able to roll over debt at reasonable interest rates. What happens if bond yields continue to rise? What happens if the cost to service this debt continues to increase? At some point, this becomes unsustainable. That's the real issue driving precious metals higher. This is the real reason precious metals need to appreciate over time. It has nothing to do with Greenland or tariffs or geopolitical theater. This is about a sovereign debt crisis that's developing in slow motion. The tariff situation could have been a catalyst that accelerated things, but removing that one catalyst doesn't eliminate the underlying problem. Think about it this way. We have a massive bubble in sovereign debt. That bubble exists regardless of any single geopolitical issue. The bubble still exists. It just needs to find a different pin eventually. There will be some catalyst at some point that causes markets to seriously question the sustainability of current fiscal trajectories. Go ahead and hit that like button, drop a comment with your price predictions for silver, and subscribe for daily precious metals coverage. Let me show you something really interesting from the Chinese market because this provides important context for what's happening globally with silver pricing. On the Shanghai Gold Exchange, silver is currently trading at 22,926 yuan per kilogram. Convert that to dollars and you get approximately $327 per kilo, which breaks down to about $102.50 per troy ounce. So while silver is trading at $32 in Western markets, it's trading above $100 in China. Now, this isn't a perfect arbitrage situation because there are restrictions on moving physical metal between markets, and there are various premiums and logistics involved. But the fact that silver is trading at such a substantial premium in China tells you something important about demand dynamics. Silver has been trading above $100 in China for over a week now. Chinese buyers are willing to pay $100+ per ounce for physical silver, while Western paper markets are trading it at $32. That disconnect is significant. What this suggests is that physical demand is strong, particularly in Asian markets. While we're reacting to headlines and seeing temporary dips in Western paper markets, the Chinese physical market is pricing silver substantially higher. That's a significant data point that shouldn't be ignored when you're trying to understand the real supply and demand dynamics in this market. China is the world's largest manufacturer of solar panels, which are major consumers of silver. China is also seeing growing investment demand for precious metals as their middle class grows and looks for ways to preserve wealth. These are structural demand factors that aren't going away. Now let's talk technical analysis because the charts are showing some really important patterns that can help us understand where we might be headed next. I had previously identified a wedge pattern forming on the silver chart, but as more data comes in, and as we see how price is behaving, it's looking more like we're actually trading in an upward rising channel. This is what's known as a bullish continuation pattern. The difference between a wedge and a channel is significant. A wedge typically indicates that volatility is contracting and that we're moving towards some kind of resolution, either a breakout or a breakdown. A channel, on the other hand, suggests that we're in a sustained trend with defined support and resistance levels. I've connected two key points here on the chart, one from January 16th and another from January 12th. That establishes this trend line that defines the lower boundary of the channel. And you'll notice that today's low touched that line almost perfectly. This trend line has now been tested 3 times, which makes it a very significant support level in terms of technical analysis. Cool. When a trend line gets tested multiple times and holds, it becomes more reliable as a support level. The fact that we bounce so quickly from that level, we're talking about recovering most of the losses within an hour, tells you there's substantial buying interest at these levels. There's capital sitting on the sidelines waiting for any dip to enter positions. That kind of underlying demand means corrections are likely to be brief and relatively shallow, even if they're sharp initially. We might get these quick drops on headline news or profit taking, but if buyers immediately step in, those dips don't last long. That's the behavior of a healthy bull market. Look at the RSI on the 4-hour chart. The RSI, or Relative Strength Index, is a momentum indicator that oscillates between 0 and 100. Generally, readings above 70 indicate overbought conditions, while readings below 30 indicate oversold conditions. The RSI is sitting around 50 right now, which is a neutral level. This is significant because we've worked off the overbought condition that existed when silver first pushed above $33 on January 14th. Back then, the RSI was significantly above 70, indicating the market was overbought and due for some consolidation or pullback. Through consolidation over the past week and this minor pullback today, we've reset that indicator. The RSI is back to neutral territory. What this suggests from a technical perspective is we're potentially setting up for the next leg higher. The market has cooled off from overbought conditions, volatility has been shaken out, and we're positioned for another move up. Will that be the move that takes us to $100? Possibly. The setup certainly looks constructive for that, or we might see another breakout that takes us to maybe $37 or $38, some consolidation at that level, and then the final push through 100. Short-term price action is difficult to predict with precision, but the overall setup looks bullish. Let's look at the gold to silver ratio because this provides important context about the relative performance of these two metals. The gold to silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. When this ratio is falling, it means silver is outperforming gold. When it's rising, gold is outperforming silver. We're seeing a small bounce in this ratio today as gold outperforms silver, which makes sense given how each metal reacted to the news. Gold held up better than silver during the sell-off. But look at the bigger picture here. The RSI on this ratio is down around 20, which indicates it's oversold. This ratio has been cut in half in less than a year. Think about what that means. At one point, it took over 80 ounces of silver to buy 1 ounce of gold. Now, we're in the low 40s. That's an enormous move in favor of silver. Silver has massively outperformed gold over this period. It makes sense that we'd see some consolidation or even a minor reversal here. Markets don't move in straight lines. After such a significant move, it's natural to see some backing and filling, but I don't think that means silver is going to fall significantly in absolute terms. What it more likely means is gold is setting up for a strong move of its own. Look at the gold chart. It's breaking out of consolidation at near record highs. You still have central banks around the world accumulating gold aggressively. The People's Bank of China just bought gold for the 14th consecutive month, according to their official reporting. These are massive institutional buyers that aren't stopping their accumulation programs. They're not buying gold because they think it's going to go down. Central bank buying is one of the most important fundamental factors supporting gold prices. These institutions are diversifying away from dollar reserves, building up their gold holdings as a strategic asset. This is a trend that's been ongoing for years and shows no signs of slowing. Gold has been lagging silver's performance recently. It might just be gold's turn to catch up for a period. Both metals have strong fundamental cases, and they can take turns leading the market higher. Sometimes silver leads, sometimes gold leads, but generally they both trend in the same direction over time. I think silver will resume its outperformance eventually, but we might see gold lead for a bit. And here's something interesting to consider about silver's trajectory. Once silver breaks through $100, the psychology could shift dramatically. You might expect heavy resistance at that round number, and there probably will be some initially. Round numbers like 50, 100, 150, these tend to be psychologically significant levels where you see increased selling pressure. People who bought lower want to take profits at these nice round numbers. But once we establish ourselves above $100, once silver is trading consistently with triple digits, retail investors who have been waiting for a big pullback are going to realize that pullback might not come. That's when fear of missing out really kicks in. Everyone who's been sitting on the sidelines saying, "I'll buy when it pulls back," suddenly realizes it's not pulling back to where they wanted to enter. $100 might not be a ceiling. It might actually be a launch pad for an even bigger move. We've seen this pattern in other markets. Bitcoin did this at various round number levels. Gold did this when it broke through $1,000 years ago. The psychology shifts completely once you break through a major psychological barrier. I've been discussing a $120 price target based on the M2 money supply to silver ratio. M2 is a measure of the money supply that includes cash, checking deposits, savings deposits, and other near money assets. When you compare the M2 money supply to the silver price, you get a ratio that tells you how much silver costs relative to the amount of currency in circulation. At $120 per ounce, we'd be back at the 2011 lows for this ratio. That's essentially an inflation-adjusted price target based on how much currency has been created since that previous peak in silver prices. It's a more accurate way to think about inflation adjustment than just using the consumer price index, which many people believe understates actual inflation. The money supply has expanded enormously since 2011. To reach the same ratio we had back then, to have silver maintain the same relationship to the money supply, we'd need prices around $120. And I actually think once we break $100, the move to $120 could happen relatively quickly. The psychology shifts completely once we're trading in triple digits. Media coverage increases. Retail FOMO kicks in. People who've never thought about silver before start asking how to buy it. That's when momentum really accelerates. Here's the cup and handle formation that a lot of technical analysts have been watching on the long-term silver chart. This is a classic bullish continuation pattern. The cup is the rounded bottom formation that took years to develop. The handle is the consolidation we've been in recently. The breakout from the handle typically leads to a significant move higher. This pattern is playing out on a massive scale over many years. The measured move target from this pattern would actually suggest prices well above $120 eventually, though these things take time to play out. Before we wrap up, make sure you've hit that like button, leave a comment with your thoughts on where we're headed next, and subscribe to the channel for daily precious metals analysis. Thanks so much for watching today. I really appreciate you being here and taking the time to go through this detailed analysis with me. Drop your thoughts in the comments. I want to hear what you think about today's price action and where you see things going from here. Are you viewing this as a buying opportunity? Are you concerned about the correction? Let me know your perspective. I'll be back tomorrow with another market update covering whatever develops overnight and during the next trading session. Make sure you're subscribed with notifications turned on so you don't miss it. I'll see you in the next video. Take care.